Hello friends, this is Ashutosh Pednekar. Today's topic is going to be the Standard on Auditing 520 Analytical Procedures. This is one topic which is what we usually do across audits, but may not pay that much attention in terms of documentation. As in how we go about doing an audit and we close the audit, all along we keep on doing this various analytical procedures. And if you look at the standard, it has these parts to it. There's an introduction, objectives, definition, there's a requirement and application of what needs to be done, and an appendix giving how the standard can be applied. So basically the scope of the standard is on using of analytical procedures. They are divided into two. One is the substantive procedures and the other is the procedures which we do at the near the end of the audit, so that we have an opinion, it helps us forming an overall conclusion on the financial statements. One of the things to be remembered in terms of SA 520 is that it has a close relationship with SA 315 and 330, which is basically risk assessment procedures and how to deal with those risk assess procedures while determining the nature, timing and extent of audit. So these are quite interlinked. It would be useful that when you're looking at the requirements of SA 520, you also look at the requirements of SA 315 and SA 330. Now, how do you actually go about applying analytical procedures? As I said, they are twofold. One is substantive audit procedures, which this slide deck calls it as SAP, and the other one is when it is nearing the conclusion of the audit. So the objective is to obtain relevant and reliable audit evidence when using substantial analytical procedures, and based on that you design and perform analytical procedures near the end of audit when forming overall conclusions whether the financial statements are consistent with the auditor's understanding of the entity. Now this is something very unique to this standard. Everywhere we've seen in other auditing standards that we need to understand the nature of the business of the entity, the management is responsible for the financial statements preparation, all that is fine, that is required and that is how it happens. But this particular auditing standards, what does it say? It says that you have to do certain analytical procedures which can be part of the substantive testing when the test of details happen. As we go ahead, we'll come to know about it. And also at the end of the audit, as we are nearing the end of the audit, we are closing it, we are in the process of discussing with the top management or the higher management and the issues where the partners come and review the audit procedures done. That is where also analytical procedures play a very, very important role. And these procedures have to be consistent with the auditor's understanding of the entity. So again, you look at the auditing standards on understanding the business of the entity, looking at the controls around it. It makes it quite important in terms of knowing those standards while applying SA 520. Definition of analytical procedures is evaluation of financial information through analysis of plausible relationship among both financial and non-financial data. So typically what really happens, in this plethora of words which are there, that as an auditor you have an understanding of the business of the entity. As an auditor you know what the processes of the entity are, you know how the management deals with a particular situation, you know the business operations. So let's say you are dealing with maybe a retail organization, multiple stores across various geographies. So as an analytical procedure, you would understand that, okay, A, is my business seasonal for certain products or not for certain products? Is my business geography dependent for certain products? I'm in the business of woolen garments. So there would be certain geographies where it will be sold more, perhaps throughout the year. There would be geographies where it will be sold at a block at certain points in terms of point in the year. So these are information which is available with us in terms of what the business looks like. So analytical procedures would help the auditor to decide that, okay, fine, if this is going to be woolen garments in winter, then perhaps the sale would be in the month of October, November, or maybe September onwards to November. So there is an understanding that these are the busy months of a particular transaction of that business. And if it's going to be sold in September to November, that means the production is going to happen 2-3 months prior to that. So you design audit procedures to understand that yes, if the production is going to happen in the month of July and August, then whether the purchases have started in the month of May and June. So when you see there has to be a spike in those purchases in the month of May and June, you can look at those transactions and determine your sample. So basically, so long then you look at the production cycle which happens in the month of August and September. So look at the higher sample size from those months for the idea of production, and then the distribution and sales which will happen in the month of October, November. So that you come to know that yes, these are the business cycles which are there, and I've applied this analytical procedure to determine what is my sample choice. So this is what is going to help you as an auditor in terms of looking at, as I said, both the financial and the non-financial data. So that's what the standard requires us to do. So we do both financial and non-financial data. We do an analysis of how the business is performing. Usually it is performing. If there are deviations to the business performance, then of course you need to change the procedures which are there. But basically you got to be consistent with the way business behaves in understanding that business, understanding how the transactions are getting recorded, and thereafter determining your sample size for doing substantive procedures, test of details, and so on. So that is the basis of analytical procedures standards, which is going to be very useful in terms of conduct of an actual conduct of the audit. So this is a flowchart for substantive analytical procedures. This flowchart actually, if you look at it, helps you at the time of initial processes of the audit, not near the end of the audit. So if you look at it, you have to determine which is the substantial analytical procedures to be done for a given assertion. Based on that, you have to determine which is the reliable database to be taken or what data is to be asked from the auditee. Then you develop the expected relationship. Like as I said, if I'm assuming that it's going to be purchases in the month of May and June, so then I look at that relationship between the purchase orders and the things which are carried out, the receipt of material and so on and so forth. So you develop those, you evaluate what are the controls around it, whether there is a risk of material misstatement happening over there. In case, let's say, if there are purchases which are not booked properly, or there are spikes in purchases, or there are lows in purchases, which is not what is expected. So you of the relationship. So that has to be a purchases criteria over there, and then determine whether any of the recorded amount, that is the purchases which are booked, are vis-a-vis your expectation of how much should have been done. Are they within a tolerance level as per your understanding? If so, everything is fine. If not, then you go ahead and do further investigation. So basically, this is what will help you to decide how the samples are to be selected, and this will help you to understand how even the transactions in an entity flow. This gives you this determination, development, and evaluation will really help you come to a proper scientific sample to go ahead and do your test of details. One of the things over there is the various assertions. Again, I would take you back to the basic standard on auditing, HA 200, where these assertions are mentioned, and you need to understand that these assertions could be in terms of the nature of the transaction of the event or the accounting balance, correctness, completeness, use of estimations. All those assertions are properly done or not, and that is where we look into the analytical procedure to be done. So over here in this particular slide, if you look at it, the suitability of the analytical procedure is influenced by the nature of assertion. So if I have to look at completeness, what do I look at? I look at all the controls around that completeness parameter, how the purchase orders are booked, how the invoices are received, how the material is received. If there's an assertion in terms of fund transfer transactions, you will look at maybe something like a bank reconciliation. You do an analysis of that bank reconciliations, and that is how you will come to a basis that whether the analytical procedures are effective enough to give you a comfort that there is no material misstatement which is happening, or there is no risk, or there is a very low risk of material misstatement. So basically we need to consider this during the test of details, especially when there are large volumes of transactions which are there. Like I gave the example of a retail trade, just to be simplistic over here. Retail trade can go into a predictable over there. They can be predictable over time in the example which we have said. But there could be organizations where the trend could be different. Let's say your auditee entity is building a bridge over open sea or over near the open sea. Now that trend would be different because there would be vagaries of nature which might impact the construction activity, and accordingly your expectation of how a transaction should be, how it could be accounted changes. So in all these cases, these analytical procedures would come in handy. On the other end of the spectrum could be complex transactions which are there. You're auditing a derivative. There is this entity which usually enters into various kinds of derivatives to hedge risk or even trade on them. So if you're doing those kind of audits, and if you need to look at analytical procedures over there, you'll need to understand on what basis they enter into derivative transactions, at what level do they usually get out of the transaction, what is the information which they take from banks, and that is what would need to be considered. So these are the factors which will have to be considered, and then you'll come into the test of details. So there would be different analytical procedures, substantive analytical procedures to be done for various kinds of transactions, various kinds of assertions which are there. Assertions in terms of occurrence, completeness, classification, recognition and presentation in the recognition, measurement and presentation in the financial statements. So all that would come in terms of derivatives or complex ESOP calculations. Evaluation would be an assertion which comes in. So all that one has to determine and understand how best way it can be done. One of the factors which are there is the reliability of the database itself. So when you're doing these analytical procedures, you need to understand from where this information is going to come, whether you can rely on it. Information at various sources should be comparable to each other and consistent with each other. Let's say, for example, information given by the purchase guy should be in conformity with the production guy. It could be in conformity with the top management explanations which they have given to you. What are the controls over the preparation of that information? How the completeness, accuracy and validity is ensured? Is there a robust enough maker-checker system which is to be done? That needs to be seen. The other one is you need to look at even the testing the operating effectiveness of the control. So of course we do have ICFR verifications to be done, but independent of that, let's say there's an entity where ICFR is not there, you would still need to look at the operating effectiveness of controls, look at the environment around those, and then determine whether this database is good enough for the purposes of doing analytical procedures. If so, go ahead and conduct the analytical procedures. But it's very important that the data which you get is proper. Otherwise, it's going to be GIGO, garbage in, garbage out. So you really need to get that in place. And then you need to identify whether their misstatements are possible. The accuracy with the expected results can be predicted. As we said, maybe it's a simplistic trade model. Across a particular period of time, the trade behaves in a particular manner, fine. If it is not a predictable business model, it is dependent on something else, then it could move. Let's say you have an organization which is heavily dependent on oil price movement or some commodity price movement. So you need to understand how that commodity prices move and then determine whether the transactions of the entity have moved in a similar manner as the commodity prices in the world, and that is where you will get it. So you need to determine the degrees at which information needs to be disaggregated or perhaps even aggregated, and then the availability of the financial as well as the non-financial information. Many a times non-financial information of the trade which is available on global known sources, you really don't have to go and buy databases. You'll just need to understand the business of the entity to go and identify that information which is available, which will help you to identify if there is a risk of material misstatement. And then when you do these analytical procedures, you find that it's quite consistent with your predictions. It's quite consistent with the way you wanted. You would have thought that this business is moving. You discuss with the management about it, and then determine whether this difference is tolerable. Based on that, if it's not tolerable, whether you need to go for higher assessments, that needs to be done. And the second one would be if that difference is much higher, then whether you need to investigate further. So if your commodity prices the world over have moved 10%, and in your organization you see price fluctuations of maybe 12-13%, there would be valid reasons for it. But if you are seeing a price fluctuation of 20%, or 18%, then it is certainly not in consistency with what is happening in the world of business, and then you need to look at other persuasive evidence to see it. This is in terms of substantial analysis. Now you look at analytical procedures while forming an overall opinion. You've done your bit of the audit. You are now coming to the end of the audit, so you need to understand, form an overall opinion on the financial statement. So again, based on the way the business has behaved, you would have got some information of, let's say, how much would be the aging of the debtors, how much would be the aging of the creditors, the way the business has moved. So you factor in those points, look at the actual statements which are available with you. So if you feel that based on the business paracycles, the debtors would be in the region of 45 to 60 days, and actual debtors are now more than 90 days, then it's a matter to be examined further whether there is a risk of material misstatement which is there. This procedure actually could throw up an unrecognized risk of material misstatement. In your earlier analysis, you may not have thought about this, and this analytical procedures may help you identify such kind of a risk, and then further audit procedures would need to be modified. According to me, this particular aspect is the key element of the standard as we near the end of the audit. It will really help you in terms of grasping the entire financial statements and their consistency. Now, if we talked about it, if things are not according to the expectations, things are not consistent with each other, you need to inquire with the management, you need to obtain appropriate evidence and perform other audit procedures as necessary. Because if this variation, let's say debtors are certainly more than 90 days when the cycle is 45 to 60 days, then you need to delve further and identify, yes, whether the sales have been properly booked or not, all those assertions of year-end balances have been done or not. This is what needs to be done. So this is how you have to use analytical procedure as a tool for conduct of audit as per other auditing standards, determining sample size, getting an overall comfort on the financial statements, in sync with your understanding of the business in which the company or the entity performs, and that will help you to maybe reach, not maybe, I would say that will definitely help you to reach a higher quality of audit perspective. That's all from me. Thank you very much.